there's a simple mechanism that can help countries around the world avoid inflation. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Hardly a day goes by without news of a country experiencing a seriously inflationary crisis. Lebanon, Argentina, Venezuela, and other states are in the midst of wild inflations. Even milder rates of inflation, like that which Turkey is experiencing, are damaging. A weak and unstable money severely hobbles economic growth. Productive investment slumps. Investing is risky enough without the added danger that you'll get paid back in a currency whose real value is shrinking. Indeed, capital flees the country. There is a mechanism that, when properly deployed, promptly ends debilitating bouts of inflation. It's called a currency board, a device that has been around 150 years. When put into effect, currency boards have always worked. A government simply uses a sound or widely used currency, which is called an anchor currency, to back its own money. Its money is 100% backed by that anchor currency. Theoretically, gold could be used as the anchor, which might make sense for South Africa, a major gold mining country. The central bank of the currency board country has no discretion. It can't print money independently, can't set interest rates. People at any time can turn in their local currency for the anchor currency, and vice versa. Now that's what local citizens love. Their politicians can't mess with the value of their money. Take the case of Bulgaria, which in the 1990s was experiencing hyperinflation. The country called in the world's foremost currency board expert, Johns Hopkins economics professor Steve Hanke, for help. A board was set up. The Bulgarian currency, the lev, was fixed to the German mark. Now, subsequently, Germany switched into the euro, as did the anchor currency of Bulgaria's currency board. But overnight, the inflationary panic ended, the lev became a trusted currency, and with that stability, the economy expanded. The Baltic countries of Estonia, Latvia, and Lithuania had similar experiences in the 1990s when they won their independence from the former Soviet Union. Hyperinflation followed by the creation of currency boards. Several years later, all three successfully switched to the euro. Hong Kong has successfully had a currency board tying their currency to the US dollar since the early 1980s. The IMF is supposed to help countries heal their troubled economies. Unfortunately, this agency habitually prescribes policies that hurt more than help, especially higher taxes and currency devaluations. The U.S. should forcefully recommend that the IMF make currency boards a routine recommendation for getting countries back on their feet. The IMF and central banks must get over the destructive idea that a little bit of inflation is good. Inflation is a demoralizing disease, period. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.